5, which is taxable estate, which is self-explanatory, I think, with the picture. What is tax on the estate tax return? Well, first of all, the cumulative gift tax is tentative until date of death. We talked about that back in module 1 or 2. And that's very confusing for your clients because they'll pay gift tax, say, in 2000, another one in 2002, and another one in 2004. And then they're told, well, when you die, we have to recalculate that tax because it's the tax is actually the tax rate in the year of death. All of the others are tentative. Next point is the estate tax return covers the estate and lifetime taxable gifts. So the estate tax is not just the estate tax, it also covers the taxable gifts during your lifetime, and that could go back to the 1920s or depending on how old the person is, 1950s, etc. It covers a long time, and that's on a cumulative basis with the cutoff of special rules before 1976 versus after 1976. You cannot ignore gift taxes when we're talking about estate tax because they're the same tax for purposes of the IRS. It's called a unified tax system. And tax rates and thresholds are unpredictable for the distant future, and they're unpredictable really even for this year. I always hate to guess at what's going to happen to the estate tax because over the years when I've done taxes, I found too often at the end of the year Congress made a change. It was retroactive. Fortunately, you're not doing the estate tax in the year of death. It's usually 2, 3, 4 years later due to what we mentioned before, and of course, outstanding debts, outstanding lawsuits, trying to take care of property that's real estate in another domain or other than the state where you're living. All of these are impact. So trying to predict the future is not really guaranteed. You do have to plan, and I always tell the client to plan on worst case. For example, I would say that for worst case, I would plan that the gross estate year of death is down to say $2 million, not the 5 or so million it is today. And sometimes unpredictable for the current year, again, repeating that issue because I find it very frustrating when I'm talking to clients or someone's preparing some plans, or maybe someone dies in a year and they want to get some answers, and I can't really give them solid answers until December 31st. Some terms used in the gross estate, in the estate tax return. First term is gross estate. Again, we went over that. That includes not only the assets you own, but those 9 other Big 10 items. And then there's adjustments to gross estates, which is basically the mortgages, debts, funeral administrative expense, casualty, and theft. Then there's deductions to gross estate, which are meritable and charitable that are qualified, and for the present time, the state and local inheritance taxes and estate taxes. After we take out the adjustments and deductions from the gross estate, we have what's called a taxable estate. Then we have the adjustable taxable estate, which is what's going to be used for calculation, and that gives us a taxable tax base. And then we have the tax based on the tax table. Now you say, well, what is an adjustable taxable estate? That's going to include the gifts tax that we paid, and we'll be covering that later. It's also going to include the gift tax, which we'll be covering in week 4. So it's a fairly straightforward, even though it's a long tax return. Again, I mentioned it's up to 50 pages tax return. It's a cookbook approach they use, and therefore it makes it very long. I would say that most people, as well as myself, manually can do the tax return, get up the numbers, and we fill out the tax return, and if they don't match, we know something's wrong the way we put the money in the information in the tax return. And it is a progressive tax. Calculating the tax from the tentative tax, subtract the cumulative gift taxes paid post 1976 to get the gross estate before credits. And subtract the following credits to get the net tax estate applicable credit amount, which is called the unified credit. But most people, although the IRS officially calls it the applicable credit amount, they also tend to use the term unified credit. Foreign death taxes and credits for gift taxes paid prior to 1977. And if there's a generation skipping tax, which we'll cover in week 8, that should also be included. And that's sort of a very quick summary because it's fairly straightforward as far as what's covered in the module. And again, if you have questions, I would wait till module 4 when we go into more detail of how the gift tax fits in, and I think it'll make more sense. I would be very surprised if you would have to fill out a estate tax return for purposes of the CFP exam, because again, the changes are so often as to how the thresholds are, etc. They're more interested in getting the concepts. And with that, we're going to go to the next module.